Hello, everybody. Welcome to our first episode of According to Carlo. I'm here with Marcus Zafaris as my first guest, and we're going to have some fun today talking about the marketplace, the mortgage business, where the market is going, some mortgage information, and I guess from my perspective as a broker owner of about 150 salespeople, the finance business, the finance side is always critical, and it's a daily discussion. So can I introduce Marcus? Welcome. Thank you for being here.
Thank you for having me.
So tell me a little bit about what you're dealing with on a day-to-day basis, especially in this market right now.
Yeah, I mean, it's a good question. So first off, we're in the middle of the largest mortgage renewal wave in the history of Canada. 2025, 2026, 60% of all mortgages are coming up for renewal. There's a few reasons for that. Structurally in the marketplace, it kind of is a result of the fact that we had such incredibly low interest rates that a lot of people had locked into. Those mortgages are kind of coming into their 5-year mark. And some people who had a mortgage coming up for renewal 2 years ago, when interest rates were quite high, locked into shorter term mortgages, which means they took 2 and 3 year rates quite wisely.
So that's making them all come due at the same time.
So as a result, we're seeing 2025, 2026, these 2-3 year mortgages are coming up for maturity, and the 5 years that normally come up for maturity are also coming up for maturity. Now, we're also stuck in this kind of limbo period because bond yields are way higher than anybody wants them to be. And there's a few reasons for that. The trade uncertainty, economic growth of the United States, inflation concerns here in Canada, all those things push up the CPI number to a level that the Bank of Canada is clearly not comfortable, and as a result, hesitant to decrease the overnight rate, leading to the bond yields to stay elevated.
Okay, but this is, you know all this, I know all this, the Bank of Canada knows all this. Surely we're going to see, or at least we think we're going to see some maybe some small drops coming soon.
So it was when we came into 2025, it was widely expected that we were going to see at least 100 basis points come off of the overnight rate. Now, we haven't seen that. And the Bank of Canada is keenly aware of the pressure that the Canadian consumer is under. They, run business sentiment indexes, and those are at the business sentiment is off of its all-time low, but just a little bit. And consumer confidence, they've got like a new indicator for consumer confidence overall, where they judge how secure a consumer feels with labor, how secure they feel with their financial stability, and how they feel about spending. And all three of those readings are at lower than they've ever been. So for sure, the Bank of Canada is aware of it. The problem is if that CPI number is too sticky, then you end up exacerbating the inflationary problem. So the problem for all these people that are renewing these mortgages right now is with bond yields at these elevated levels, you get a real problem because the mortgage rates aren't as low as people want them to be. Like we saw 5-year fixed hit sub 4% for a little while there. Now everything's kind of above 4%. Like the best 5-year fixed rate, maybe you can get something with a 3.9 on it. But Canadian consumers were hoping for more. They were also hoping that they could lock into a variable rate at prime -1 and then just sit back and relax while the prime rate just continued to drop and got, they experienced the benefit of that. Neither of those things are happening right now. So with all these mortgage renewals coming up, consumers are feeling tight.
And some of these renewals, like they're sub 2%. Am I correct?
Oh, yeah.
So even though rates are still at 4, which is still historically incredibly low. I mean, I've been doing this for a very long time. I mean, even when I started back in the late 80s, we were 12, 14%. So historically, they're still very low, but they're doubling their rates from 1.7, 1.9 to 4 and 4 and above that.
Yeah.
So the payments are double.
Yeah.
Everyone knows this. Employment's still very high, which is great, but it never ceases to amaze me on why, what's the government going to do about this? Like I said to you again, I said, repeat myself, but everyone knows this. And the banks seem to be a little more flexible because they're offering so many different payment terms. Is that correct? I mean, what are you seeing in terms of what the bank is doing, what the banks are doing to alleviate this stress?
So for sure, you can increase your amortization schedule. A lot of people, that's how they got into trouble, is with these increased amortization schedules, or people are coming in right now with a mortgage statement from CIBC or RBC, and it'll show that they've paid nothing down on their principal in the last 5 years, and in fact owe more money than they did initially because their mortgage product was negatively amortizing. And the banks are keenly aware that people can't cover these monthly payments, and as a result are just blowing out the amortization schedules. The problem then becomes is that the banks have to report to their shareholders,
Of course.
and shareholders have an eye to what the amortization length of a portfolio is, and that affects how the stock price, not to a great extent, but it does have an impact on how and which banks are favored. So, investor doesn't want to invest in the bank that has a whole bunch of their portfolio sitting at over 50% annual or 50% amortizations.
Yeah, I guess from our perspective, from a brokerage perspective, we're obviously very concerned about it. Our volumes have been down quite a bit, but a lot of it has to do with people just can't afford to sell. They're sitting on 1.92% mortgages. Why would they sell? It's just, I would like to think that there's going to be a slight drop in the rates. I think that'll help a little bit. But again, I'm finding that the banks are trying to do whatever they can. I mean, I've even heard, maybe you can explain to me a little bit. I've even heard reverse amortizations, like where people are actually paying less than what the total payment would be, but their principal goes up.
Mm-hmm.
Like, are banks doing this?
Not intentionally. So it would be very rare. There'd have to be a significant equity position, and it would likely be the result of an old variable rate mortgage where the
Makes sense.
interest amount, where the payment amount was fixed based on a historical rate, so a historical prime rate and a historical discount to that prime rate, and on the remaining length of that mortgage, as a result of the payment not adjusting, the interest is just accumulating in the principal account, but not on a renewal. Like, it's very, very, I haven't seen it. I haven't seen a bank offer it on a renewal where someone can just kind of add the interest to the principal of the loan, not for an institutional mortgage. There's a ton of private lenders out there right now, and you can see this, real increase in popularity in the mortgage investment corporation and private lender space. The non-bank lenders are really increasing their portfolios right now, and they're offering balloon interest payments. But that's typically a second or an equity-based first, and it's got a balloon payment at the maturity.
Okay, so when you're doing new applications today, are you recommending variable rates, fixed rates? What do you recommend mostly?
Yeah, variable rate.
Because you believe it's coming down.
2 reasons. Reason number 1, very simply put, the rates have to come down. And if you want to think about it, you have to imagine it like the scene from Braveheart where he's telling everyone to hold,
Yeah.
hold. So in our case right now, the longer we hold interest rates in fear of inflation, the more damage we will do to our economy on a medium to long-term basis because of how constrained the consumer is. Over a period of time, if we leave interest rates elevated and we continue to do this and the economy continues to stagnate and move into a recession, we will have to do more to resuscitate the economy when inflation is no longer a problem. So once inflation is no longer a problem, meaning these core CPI numbers stop being in this 3% range, once we see that abate, then we'll see the Bank of Canada step in and aggressively drop interest rates. If this happens for an extended period of time, then the drop will be faster and it will be more pronounced in an effort to resurrect what semblance of an economy we have. As a result, a variable rate mortgage holder will be rewarded. They may not be rewarded as immediately as they were hoping. Read September, October, December 2025 rate cut opportunities with the Bank of Canada, but they will be rewarded then in early 2026.
Yeah, because the spread, what's the spread now? If I do a 5-year fixed, 419, 420, does that make sense for a 5-year fixed?
Yeah.
Versus a variable, what am I paying on a variable?
So that's a great question. It kind of leads me into reason number 2 why I think you should take a variable rate is that variable rate mortgages, as interest rates drop, as the prime rate drops, that the discount available on a variable rate mortgage shrinks. And this is like another analogy for you. It's like giving birth. A woman always forgets how difficult it was giving birth. And it's like a mental thing so that she'll want to have another baby. But
apparently, yeah.
I remember how difficult it was.
Yeah,
Anyways,
we all do.
yeah. So, but when it comes to variable rate mortgages, historically, you always see this happen. It's the banks, when a product gains in popularity, meaning when demand surges for a product, and the bank has 2 products, they got a 5-year fixed, they got a 5-year variable. If they see demand surging for the variable rate mortgage, the discount off of prime that they offer starts changing. We used to have, a couple months ago, we had a prime minus 120 basis point variable rate mortgage.
Wow.
So you were at 3.75% at a 495 prime. Now we're seeing those rates start to creep up, and they're at prime minus 1, prime minus 90, prime minus 80, we got some lenders at prime minus 40 right now. So the discount off of prime starts shrinking. And you better believe that as prime rate starts dropping and the overnight rate of the Bank of Canada drops because they're injecting stimulus into the marketplace, the spreads on those variables are going to tighten. So your question of like, okay, 5-year fixed right now is 4%. 5-year variables, probably 4.2. You're probably paying a premium for that variable rate.
Of course.
But if you don't take it now and you wait 6 months, the discount off of prime on the variable rate,
it's going to shrink.
It might not be prime minus 1. You might only be able to get prime minus 30.
And then you need a much longer time to recover the difference.
And I don't know if you remember, but if we're going to talk about forgetting how we gave birth, in 2009, when we had a real financial crisis brought on by what was going on in the States, but nonetheless, a real crisis of confidence in the Canadian banks, variable rate mortgages went from prime minus 120 to prime plus 1 in the span of a month.
Oh, yeah.
Prime plus
I
1.
remember. It stopped everything for a good 6 months in Canada.
Right.
I remember that distinctly. I mean, in the States, it lasted much longer. I mean, we came out of that pretty good. It lasted. I just remember our phone stopped one day in 2009, just after the 2008 crisis. And then 6 months later, they just took off again. And it's been a pretty good run since. So yeah, I hear that. I guess, so are you telling me that you feel that the rates have to come down? You're just telling me that come the springtime, we're going to see lower rates.
I feel that as long as that CPI number can come off, as long as the heat in that inflationary number can come off, the Bank of Canada absolutely cannot and will not leave the overnight rate where it is right now. It's creating a real problem.
It'll be too damaging.
And they know that it's damaging right now. And right now, for all intents and purposes, we're in a period of stagflation where the economy is stagnant, if not receding, in a recession. And we have inflationary pressures. And there's nothing worse for an economy than that, because your central bankers have their hands tied. And even if there's a fiscal stimulus that comes in from spending, like the defense spending we're talking about, additional infrastructure spending projects, those are still inflationary, right? So the Bank of Canada kind of has to keenly watch that stuff too. Maybe it's fortunate in this situation that the Prime Minister of our country has history as being a governor of the Bank of Canada, so he's keenly aware of the challenges that the central bank faces. Okay,
I don't really like to bring in politics into these discussions, but obviously what happens in the United States affects us. So our rates have dropped quite a bit lower than historically. Usually we're on not quite parity, but we're not usually this much of a spread, correct? Between the US and Canada. So they seems to be pretty sticky down there. So is Canada just waiting for the US to start dropping before we see that here?
Yeah, for sure. The governor of the Bank of Canada is cognizant of the differential in our interest rates. And there's like a very kind of simple economic model where basically you can take advantage of currencies, because it's kind of like currency and interest rate in one country. There is a very specific equation into what the currency and the interest rate needs to be in another country based on their interdependencies. Yep. So obviously some of the interdependencies are being challenged right now, But whenever you see the interest rate in one country hold while its major trading partner, that interest rates begins to fall, or the expectation that that rate will begin to fall, so you can see it in the bond markets first, then the currency will start to fall because for multiple reasons. But if you just imagine like you had $1 of capital to invest, then the price of that dollar in the local currency would be impacted by the rate of return, the risk-free rate of return in each of those countries. So we do not want to see our Canadian dollar weaken further, because then it introduces more inflationary pressures, which then would put us further behind the 8 ball with respect to combating inflation. We want to try to keep it stable to the United States. The United States would also, for the most part, like to drop interest rates, but they are dealing with their own inflationary pressures as a result of the tariff action.
So I guess, it's a crazy balancing act, because, you know, a lower dollar for us means we trade better to the United States, because, you know, although most people don't like that, most of our trade is with the United States. Mm-hmm. And so a lower dollar is better for us. So I always find, you know, what is it that they're trying to do? Keep our dollar at a certain level, keep interest rates at a certain level, because they just obviously run in tandem with each other. And so, you know, given the situation, given the politics, I never really know what their motives are and what they're really trying to do. I mean, they have just so many factors, so many, you know, metrics to deal with in terms of making those decisions on interest rates. Okay, let's move on to
Bank of Canada's main mandate is to maintain inflation at 2%.
Yes.
Secondary mandate, which was only recently introduced by Chrystia Freeland when she did a press release with the governor of the Bank of Canada when she came in as a Minister of Finance, was to maintain employment at some level, thereby affecting kind of confidence and spending.
Right.
But for the most part, every central bank around the world is like, they just want to keep inflation running at 2 points.
Yeah, they want that 2%. Yeah. It's an incredible magical number from our Economics 101. Okay, let's just move on to, where do you see, okay, you do some private lending too, am I correct?
Yeah.
Okay, so are you seeing power of sales?
That's private though.
Okay, it's private. But the private lending, are you seeing power of sales on the private side, on the banking side? I don't see, as a broker, I don't see that many. I mean, look, I don't want to age myself, but back in the early 90s, we had 5 years of, 60 straight months of declining prices from 1990 to 1995. I remember it like yesterday. And we were dealing with a lot of power of sales. The banks were a lot more ruthless in those days, in my opinion. You didn't pay, it just went power of sale. And so there was a lot of those. And we didn't have as much private lending from what I remember. I guess my experience was back then. But now there's a lot more private lending, in my opinion. What are you seeing there? Are you seeing there being some stress in terms of people paying their bills? And are there power sales coming out more than you would like on the private side and also on the institutional side?
So we've been very fortunate. We have not seen defaults. Very, very few power sales, all of them in a beneficial equity position where, a power sale, the way it works, basically, if a lender takes over and sells a property, any surplus equity goes back to the borrower anyways. So, however, I will say, generally speaking, in the marketplace, we are seeing more power sales. And as you identified, it's happening from the non-bank lenders.
Yeah.
The banks, it almost seems as though the banks are working together to hold off on defaulting borrowers. So providing solutions to borrowers to prevent this additional liquidity from hitting the market.
And that's what I was saying before. They didn't do that in the 90s. They were just, you didn't pay, boom, it was done.
Yeah.
I find now they're really working with people because they can see, as we talked about, 25 and 26, how many mortgages are coming due. If they start, when you owe the bank $1 million, it's your problem. When you owe the bank $1 billion, it's their problem.
Right.
And so I think it's their problem with all these mortgages coming due. So they have to play some sort of ball here to make things a little more palatable.
Yeah. You see kind of different solutions for different verticals for the bank. Right. Like, I think the biggest thing that they're probably concerned about right now is the loans that they've got to developers on condos that are being completed. And what we're seeing there is like these blanket appraisals that'll come in at the purchase price for the bulk of the consumers in a condo building or a new home development, and allowing therefore the counterparty risk on this like $500 million loan to be shifted from the developer to 1,000 different borrowers who each have a unit in there. And for the bank, it makes a lot of sense because you're diversifying your risk.
Correct. Not everyone's going to default. The builder could default, but not all the owners will.
Right. So it mitigates the risk a little bit. Sorry. For the other segment of the market, like the developers that have land loans, it's a bit more tricky.
It's very tricky.
And there's some institutional lenders that are operating in that space where they've done land loans when developers were buying land at $200 a foot. And now land is trading at sub $100 a foot in the city of Toronto, maybe $80 a foot.
If it's trading.
Yeah. And it's not trading, but you see stuff starting to get picked up in that range. As a result, the banks have to work with those developers, and maybe it's a pay down, but those loans, if those go bad, then it's a further flood of this inventory into the marketplace. So at some point, because the banks control so much of the market, they can work together to kind of create a bit of an artificial floor in the market, in the hopes that, and again, it's like everyone's holding, right? In the hopes that when interest rates come down, that more demand comes into the market, and that this artificial floor can actually then start lifting naturally by the demand that comes into the market.
So I ask all these questions selfishly because as a broker, we don't focus so much on prices, even though people think we do. We focus on volume. We need turnover. And so I ask you all these questions because where do you see the turnover coming in the spring? For 3 years now, we've had 35, 40% drops, not only in revenues, of course, but in turnover. And it's like we said, people just can't move. So where do you see this? I guess, this might be a little too difficult for you to answer, but I'd like to know from a brokerage perspective, where are we going to start to see the volume pick up? Is the financing issue going to start to see, is the financing issue going to force more volume turnover?
I think the short answer is yes. The spring of 2025 will be a more robust market than the fall and spring. Sorry, of 2026 will be a more robust market than the spring and fall or kind of any part of 2024, 2025. And that the reason for that's probably twofold, right? Like number one, for sure, we got a whole bunch of mortgages coming up for renewal where people are going to start thinking about making a transition if they've been waiting. And then the second part of that is naturally a marketplace does have buyers and sellers. It's just gone away because of fear. But at a certain point, you can't hold that off. Like people are getting divorced, people are passing away, people are having babies. And those people need to change their living situation. And eventually, they're just going to enter the marketplace. I think we're seeing that now already.
Well, we do have, like when you price stuff, I think the biggest difficulty that we have today, and we have a lot of inventory, and I'm constantly coaching my agents, is that the sellers just don't want to know what their home is really worth. They don't really want to bring it to a point where a buyer has the incentive to buy it. And so that's a constant, it's a daily issue. For us. So, I'm just, it's this, the buyers, there's buyers out there. And I always say our market is split into two groups. And Canadians, I've been doing this almost 40 years and Canadians love to buy and sell real estate. They just love it. And it's been great for us. But I find there's two groups, people who really need to buy and sell, which is 50% of the marketplace. And that's what we've had the last 3 years. People who just really needed to buy and sell for whatever reasons. Could be financial, could be personal, whatever the reasons are. The other half of our market, I think, is, husband and wife says to each other, or partners say to each other, hey, let's move on. Let's get a bigger house. Let's get a smaller house. So stuff that's not urgent, that I think is the other half of our market, which we have seen none of because that kind of thing has been stopped by their financing issues. So I'm just hoping that we start to see a little different, an uptick in the spring. And I thought it was going to happen this spring, frankly. And I told people that. I think 2025 spring is going to be great. I was wrong. And it's just kept the same, but it hasn't really changed a lot. It just stayed pretty low. So I think you're right. I think that, we're only going to be held back for so long. And I think the spring, I'm looking forward to the spring, just like you said. Marcus, tell me a little bit about, how long you've been doing this business? How long you been in the mortgage business? And how did you end up in the mortgage business?
So I've been doing this for almost 24 years now. So I think September will be 24 years.
Wow.
And I started out of university. I went to investment banking.
So did I start out of university, but that was 40 years ago.
I mean, it's crazy that it's even been that long for me, right? Like I always kind of was like the youngest guy at meetings or something.
Of course.
And now that's not the case anymore.
Yeah. Tell me about it.
And so I went into investment banking, and then I didn't last long. I was like, it wasn't so much the hours, but it was the type of work. Like it was a lot of just kind of being buried behind an Excel spreadsheet and going through quarterly reports. And it wasn't for me. And I moved over and started brokering mortgages. And like, honestly, within 4 or 5 months, I found a building at Dundas and Runnymede, and I bought it for $240,000.
You bought it yourself?
Yeah.
Good for you.
With 5% down.
Wow.
And rented the apartment upstairs, put a big sign that said Mortgage Marcus at the front of it.
Wow.
And had a desk.
So you're on your own? Yeah.
And had a desk and like a cot in the back. And I lived with my parents. So some nights I would just sleep there and like kind of work, because I was like, I would go out during the day and go for lunches and take people for dinners and hustle probably in one of your offices. I was in there. I would bring coffee and sweets for the receptionists, and then they would let me stick my flyers in all the mailboxes
people still do that
at the brokerage. And then I remember every morning I would print 3 types of flyers. I would print flyers that I was going to give to realtors, and then I would print door-to-door flyers that I was going to knock on doors and hand out to people. And then I had these 8.5 by 11s with phone numbers cut at the bottom that I would put up in elevators of rental buildings saying, why rent when you can own? And then I would just wait for the phone to ring. But every day, I forget the numbers, but I think I had to do 500 realtors, 100 elevators, and 1,000 doors.
Wow.
And then I would go home at the end of the day.
But it's a numbers game.
Yeah.
It's a numbers game for you. It's a numbers game for us. And I just tell people, look, there's no magic pill. But the formula in our business is it's not complicated. It's pretty simple, just like that. It's a numbers game. It's just hard to do because it's hard to get people to be that disciplined and create those relationships and meet people every day. But if you do it, it will come.
For me, it was out of fear and embarrassment, because I was at Laurier and I got like this great job in investment banking with like a really great salary and like a signing bonus. And, I would see my friends from university. And then at a certain point, I wasn't in investment banking, which was like this coveted role. I was a mortgage agent. And, it's not as illustrious as a career path. And I was driving around my mom's Subaru with, a photocopier was my best friend. And I was like, I got to get some deals going and start making some money, or else I'm going to look like a schmuck. And this is going to be a bad decision.
Yeah, but if you don't experience that, you don't become who you are. I mean, I got my license between second and third year at U of T. I did my commerce degree at U of T. And I was supposed to become an accountant because I did my BCom. And they would come and interview all of us as students, and they'd come and, want us to do articling with them or whatever you call it. And in those days, I hate to date myself, that the salary was $22,500. I remember like it was yesterday. That was our salary coming out of university. And my third year of university, I made $45,000 selling real estate. And I said to the guy, why would I do that?
Wow.
This was in the late 80s. So things were crazy. And then in my fourth year university, I sold like 60 condos at 90, 80, 90, 100 grand each. And I made $70,000
Amazing.
In my fourth year. And I thought, this is crazy. The world is easy. Life is easy. And so I did my commerce degree, got out of real estate. I opened my own brokerage up right away when I was 24 years old. But then 1990 came right away. And it was tough. And I bought property, lost everything. So it was the best, the greatest and worst thing that could happen to me, because I wouldn't be where I am today if I didn't experience that. So that's why I'm interested to always hear people's stories on how they start up and where they came from. Because it's fascinating to see. But if you don't have those experiences, we don't become who we are.
Yeah, for sure.
Okay, last thing, Marcus, is what are some of the myths that are out there right now on refinancing, on buying, on purchasing, whatever? Like, tell us, we hear so many things of what's happening, what's not happening. In your opinion, what are some of the myths out there?
Listen, I would say the number one myth that I'm still so shocked that it exists is that a bank is an unbiased place that you can get a financial consultation. Like, it still makes no sense to me that Canadians are so loyal and trusting of their bank. There was a Bank of Canada report out. I mean, when I first started as a mortgage broker, I found it and I loved it. The Bank of Canada, and it was Stephen Polo's, before he became the governor, that was one of the authors of this report. And he basically said that if Canadians have all of their banking with one bank, it is found that they receive worse rates.
Of course.
Because the bank identifies them as a sticky customer that they can sell whatever they want to. And if a bank or if a client uses a mortgage broker, they can access much lower rates and therefore be the beneficiary of more monetary stimulus that the Bank of Canada is trying to inject into a marketplace. Bank of Canada issued a report saying if everything was going to work well in this world and in Canada, and Canadian consumers are to receive the immediate benefit of monetary policy, they should use a mortgage broker. Of course, nobody advertises this report. And of course, the banks want to tell you that the green chair is comfortable and that you're richer than you think, but it's all garbage. The bank is just trying to sell you a product and receive the maximum margin they can. Like, the banks are run off of something called net interest margins. The difference between what they pay you for your savings and what they charge you for your debt. And every bank is judged on net interest margins. We look at the net interest margins, we say, wow, Royal Bank hit 2%. That's amazing. Let's buy more of that stock. That's a well-run company. And we look at CIBC and we're like, oh my God, they're only at 1.4%. We're not going to buy them. Their stock price is going to fall. But at the end, more consumers are the beneficiary of a low net interest margin than they would be of a high net interest margin. The bank is capable of talking out of two sides of their mouth. So the next time somebody goes in to negotiate anything with their bank, I would just caution them and say, you need an advocate. You need somebody working for you to cut through that.
Of course. And the banks will compete if they're forced to.
Yes.
And so without people like you, they're not forced to.
Yeah.
And we've heard that so many times, people just walking into a bank and say, oh, I just wanted to talk to my bank. I think what it is too, though, it's familiarity and it's trust. They just think the bank is there. And if there's ever a problem, they know where to go and complain. But you're going to put them with an institution anyway. So if there's an issue, they can just go to that institution and deal with them. Or better yet, deal with you and have you advocate for them.
Right.
So it is. It's something that has been going on for a long, long time. And I hear this all the time from people like you. Why would you do that? And it makes so much sense because you're out there. Obviously, it's theory of competition. You're just trying to get the best rate. And the banks will compete for each other. Because I know that I when I got a mortgage, I have private banking with CIBC, and I had gotten a quote from somebody, and then CIBC was a little bit higher. And I said, but hold on, I got this quote from so-and-so. Okay, we'll match it. So it's incredible how that can happen. So thank you, Marcus, for all that information. Great information. If I can just say that, listen to what we had to say here and consult with your clients on a daily basis. Make sure they're fully aware of their options, especially when it comes to financing. And Marcus is 100% correct. We've seen this for years where people would go to their banks, sign up, and then realize there was a quarter point or half a point left on the table. So again, if there's any message coming out of today, is make sure you know your options, especially going forward into 26 and 27, because it can be very critical in terms of what your mortgage will cost you. Okay, thank you, everyone. And thank you to Marcus for joining me today. Look forward to many more podcasts coming, and I hope you enjoy the show.